Well, 8 is great, or at least that's the way the thinking goes. According to CNBC, we did have our 8th straight up day for the Dow Jones Industrial Average. So nice little turnaround for stocks here recently, but there are a couple of signs that we'll get into in the video here today to show you that maybe not everything is perfect, but for the most part, bulls have been happy recently. Of course, I've been in Omaha and back to the Warren Buffett Berkshire Hathaway meeting, and so happy to be back in the saddle for you here today. And what we'll be reviewing from a trade perspective today will be a follow-up to an old trade I did about a month ago in a very hot sector. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee, and it is May 14th, 2018. Well, first things first, David's out of the office this week, out on vacation, getting some much-deserved R&R. So not only am I in charge of teaching all of my daily classes for my premium subscribers over at Market Scholars, but I'll also have to determine what I want to do about this free Market Outlook video here on YouTube that many of you watch. And so what I've decided to do is use that number of 100 likes on Twitter that I've discussed many times in the past. I kind of view that as a pass-fail. If I'm getting more than 100 likes on Twitter on any one of these video tweets, I feel that I'm reaching out to enough people where the hours that go into producing this video every day are worthwhile. If it's less than 100, then I have to start determining, is it really the best use of our time here at the company in order to sink so much time into this free product? And so I'm going to be using that number of 100 likes on Twitter all week long to determine whether I'll do the video the following day or not. So of course, today is Monday. I'm doing the video for sure right now. What we don't know is whether I'll be doing the video 2, 3, 4, 5 times this week. That's entirely up to you. We're still trying to determine whether we need to have the free video every day, a couple times a week, maybe just once on the weekend. So again, your guys' activity and engagement with us on social media will be the determinant factor on whether we do these on a daily basis. And so how this will work is I will look at my tweet from the prior day regarding the Market Outlook video, and if it has 100 likes on it, then I will do the Market Outlook video the following day. So tomorrow being Tuesday, I'll look when the market closes whether I got 100 likes on the Monday video, and if the answer is yes, I'll do the video on Tuesday. If the answer is no, I won't do the video on Tuesday. I'll then look on Wednesday to see if that most recent tweet did get 100 likes, and if it did, then I'll do it that day, and so on and so forth. So you have me for sure today. Whether you have me for the rest of the week will be entirely dependent upon you, and whether you're willing to give me just that one click to click the word like on Twitter. Now, some of you might be asking, well, how do I go ahead and do that on Twitter? It's reasonably easy. Many of you have Twitter on your smartphone as an app, and so all you'd have to do is look me up on Twitter. My handle's at Brandon Van Zee, all one word. In addition to that, if you don't have a smartphone, you can just go to Twitter on your desktop. I've got that pulled up in front of us right now, and as you can see, I'm on my Twitter profile. So remember, one of the things that David and I make really easy for you guys to find these tweets that we're referring to in these videos is we pin it to the top. Twitter gives us the ability to pin one tweet to the top, so that way we can kind of stick it there. So last time I did the video was on May 3rd, since I've been away for the Berkshire Hathaway meeting here in the last week. So the last time I did it was on May 3rd, and you can see that I got 92 likes. Now, I've been up to 138 and a bunch of other numbers above 100 consistently. So I know that 92 is not necessarily the norm, but I also know that if we don't remind you regularly, then we kind of slip off on the numbers again. So this week will be a good way to help you develop that habit that if you like the analysis David and I give you on a daily basis, make sure you're liking our tweets on Twitter. That'll be pinned to the top of our timeline right there. A couple other ways, if you don't want to go directly through Twitter, that we make it easy for you to find that tweet. On the YouTube video itself, remember we have a description area under the YouTube video, and one of the description area links right there will be a link to that particular tweet. So you can just click on it directly from there and like it once you get over to Twitter there. In addition to that, of course, we also have the ability for you to like it directly on the Market Scholars website. So when you go to our blog where we post the video itself, remember underneath the video, you're going to see both Twitter up here at the top, and also Facebook right below it. So it's nice and easy. You can just click like right there, come down and click thumbs up on Facebook, and even give us a thumbs up down here on our website as well. So that's another easy way for you to go to Twitter to like these tweets. And then the last place would be really on our email. So let me pull up an example of an email here. Here we go. And you can see that if you're on our email distribution list, which many of you are, basically the format of the email generally the same. You can kind of watch the video. Hang on just a second here. And you can kind of start scrolling down here. Down towards the bottom, you'll see on both David and I's emails, there's kind of a social media block down there. If you clicked on that Twitter icon in that social media block, it'll also take you directly to Twitter to like it. So at least 4 different ways to make it nice and easy for you to, all you have to do, you know, you're voting with your click. One simple click, you get at least 3 hours worth of work out of David and I on a daily basis. All right. So anyway, again, if we get to 100, I'll do the video tomorrow, and then I'll keep on doing them, you know, constantly after that, as long as I'm constantly getting 100 likes. So thank you for your diligence in doing that. It is much appreciated. So let's go ahead and do some analysis on the market now. Well, one of the things that I learned from Mr. Buffett while I was back in Omaha for the meeting last weekend was that he really valued his insight and the perspective that he's gained by being in the market all of these decades. And he shared a story starting off with his question and answer session with a newspaper from the New York Times showing what stock prices were and what the headlines were in 1942 when he was an 11-year-old boy buying his very first stock. And so I took a page out of his notebook and picked up this right here. Now I know that's probably going to be a little bit difficult for you to see in the camera itself, so I do have this pulled up here on Paint as well to make it nice and easy for you. But this particular newspaper I saved from 2001. I was reasonably new to investing at that time. I'd only been investing for a couple of years, and so you can imagine the shock that came with understanding that stocks could move as quickly as they did. Now, you'll recall that after 9/11, stock market didn't open for about a week after that. And when it did, this was the newspaper in response. You can kind of see here it's Tuesday, September 18th. So basically a week after 9/11, they finally opened the stock market back up. And as you can see here, the headlines read, stocks tumble 5 to 7% despite the Fed's easing. And so let me zoom in a little bit more, and you can kind of see some of the numbers up here as well. Dow Jones Industrial Average was down 7% in one single session. You can see the NASDAQ was down 6.8% in one single session. So I'm bringing this up because, yes, 2018 has been a choppier year than normal. And for those of you that just started investing in 2017, 2018 has probably felt a little bit gut-wrenching at times. But the truth of the matter is what we've seen so far in this particular calendar year is nothing compared to some of those more trying times in market history. And so when you go into the stock market, make sure you're only risking money that you can afford to lose. Don't try to juice your returns with a whole bunch of margin or leverage or different things like that if you can't afford to lose that money. So just a little bit of a history lesson there to remind us, stay calm. We haven't had very many 2% days here in the last couple of years to the downside, let alone 3%, let alone 7% like we saw here in 2001. And so try to stay calm, cool, and collected. David and I are here to try to provide a level-headed analysis of the market. And it doesn't guarantee the markets are going to keep on grinding up forever, but it is a reminder that you should be position sizing properly so that way you never panic even when markets do turn against you. As it stands now, of course, markets have been on a decent little run here in the last couple of weeks. In fact, saw on CNBC here a moment ago that it said that the Dow Jones finished 8 days in a row to the upside. So as we come back on over here, oh, and by the way, for those of you that want to gain more insight from what I learned at that Buffett meeting, for those of you that are already premium subscribers to Market Scholars, I did teach a class about my experience back in Omaha. That one is posted here as of May 9th, 2018. So again, for those of you that are already part of the premium Market Scholars program here, feel free to check out that video if you want some of my insight of my takeaways that I received from Mr. Buffett and Mr. Munger back in Omaha. All right, let's take a look at the market here. You can see the S&P 500 today did close up, but it was essentially flat. You look at this candle over here, it doesn't really do a whole lot to give you hope that we've got another string of 7 or 8 days in front of us. Of course, this is the S&P 500, not the Dow, but like a lot of times, you'll find that the S&P and the Dow generally kind of drift higher and lower together. And so as it stands right now, this isn't the best looking candle. A lot of times, this type of a candle would be known as an indecision candle because you have kind of that long shadow on the top and on the bottom, that thin part of the candle there. And that tells you that bulls and bears were kind of fighting it out throughout the day, and then they kind of met in the middle at the end. Now, one thing that I will point out is that according to the trade setups that we look at here using that market forecast indicator, remember, we're looking for things like a bullish intermediate confirmation signal. For those of you that aren't familiar with that, David actually taught a whole technical analysis class on the various trade setups for the market forecast indicator a couple of Fridays ago, for those of you that are Market Scholars Premium subscribers. So feel free to go back and check that out. But the bullish intermediate confirmation signal occurs when we have that green intermediate term line that is bullish. So first things first, what distinguishes a bullish from a bearish posture using that green intermediate line, which is oftentimes how we set our posture using this video as kind of a general overreaching effect there. So you can see here that the intermediate term line is in the upper reversal zone. Now, sometimes people will automatically assume, well, geez, if it's up in the upper reversal zone, that means that it's about to reverse lower, and that's got to be a bearish sign, right? Not necessarily. We often find that stocks that are hot, or in some cases indexes that are hot, can stay in that upper reversal zone for months, sometimes 3, 4, 5 months in a row without leaving the upper reversal zone. So just because it's up there does not necessarily mean that some terrible thing is about to occur. In fact, we would view that very positively. It's about the strongest that a bull market could be from an intermediate term perspective. So right now we do have a bullish posture. But remember that the other way that you would determine if the posture was bullish is just if that green line was trending up between these black lines on my chart. So the top black line is 80, the bottom black line is 20. So basically this entire period from late April to where we're at right now, we've been bullish except for this tiny little period right in there where it slipped for just a couple days, maybe even just 1 day at that point. So for the most part, we've had a bullish market, even though it hasn't necessarily felt like that for a lot of folks that are out there. So that's the first piece of the bullish intermediate confirmation signal. Make sure that your intermediate term posture is bullish. Check. The other check that we need to look for is the momentum line, and that's your red line down below here. Notice that that momentum line is now in the lower reversal zone, and it just barely poked in there, and that's actually what we like to see. Sometimes if it goes down too far in the lower reversal zone, we get the fear that there's a changing of the kind of the sentiment of traders out there to be more bearish. So if it can kind of catch its balance right around that 20 mark and then bounce out of it, we're generally fairly accepting of that if we want to be bullish on the markets. So as it stands right now, we have a bullish intermediate posture. We have an oversold momentum line. So that's kind of a buy the dips type of a mentality there. So that would be maybe one more vote of confidence for this market right now. In addition to that, of course, we've got the strong bullish posture along with that moving average line right there. This is a 30-day moving average that is green. And what that distinguishes is if price is above a rising moving average. So a lot of those things kind of coming together here for the bulls all of a sudden. Let's take a look at another chart and maybe take a peek at, let me actually go over here to our 4 grid. And this will be chart 4B. For those of you that have gone through my charting tutorial, for those of you that are premium members of our company, remember you can always check the chart label in the upper left to determine which chart I'm looking at, so that way you can follow along on your own Thinkorswim platforms if you desire. So as we look at these various indices here, remember these are the 4 main indices here in the United States, trying to get a feel for what's been going on from a posture perspective. First things first, notice that the color background is green the furthest to the right in all 4 of the charts. So what that tells us is we do have bullish postures on all 4 of these major US markets right now. In addition to that, we have green moving average lines across the board as well. And again, what that stands for is prices above a rising moving average. That's also a bullish indication. So you might be asking, well, how do we kind of distinguish between them? Sometimes you can't, because honestly, stocks are so correlated these days that many of the major indices kind of track one another. But I would say that right now, if you want to look at the Russell 2000, that was a kind of an ugly candle that we got today. Notice the Russell 2000 is actually down 0.4% today. It's a fairly aggressive day considering the rest of the market was bullish. Notice the Dow Jones finished up by 0.27%. Already talked about how the S&P 500 was up. And then, of course, we've got the NASDAQ composite down below here that was up 0.11% as well. So keep your eye on the Russell 2000. Now, the good news is before it kind of spilled over here earlier today, we did find that it touched a new high. So we do like to see that Russell 2000 kind of be a leadership index, because it kind of gives us the sense that there's a risk-on environment that is occurring right now. Typically, it's a lot easier to push the small caps up and down as opposed to the mega caps of the Dow Jones. And so when we see the Russell 2000 going a lot higher, we kind of assume that it's a risk-on environment, and hopefully the other markets will kind of follow suit. So we've got a little bit of a mixed bag there. Yes, on a one-day perspective, it's a bit disappointing to kind of see that candlestick formation right there and to see a bearish candle. But for the most part, it has been good to see that the Russell 2000 has kind of exerted its leadership role here recently. Let's take a look at some other charts here. This time, let's go over to the 1040 crossover method chart. And here you can see that we do have green backgrounds. And so as a reminder, this is a chart where we're looking at a weekly candle. The other charts we've been looking at so far, daily candles. So this is a weekly candle chart. And what we're looking for are crossovers of the moving averages themselves. You'll notice on this chart we have the 10-period moving average in the orange, and we have the blue line representing the 40-period moving average. And so we're looking for the orange to cross below the blue moving averages in order for us to then have a bearish longer-term posture. And that has not happened yet. We got in some hot water a couple of weeks ago where prices were down there. Notice as just an example on the Russell 2000 here, I'm just going to right-click on this 4-grid here and go to maximize sell, so that way we can see that 1 grid real up close here. So you'll notice that on this candle, we fell all the way down here. We breached that blue line, which is a 40-period moving average. Some of you that use daily candles could consider that the 200-day moving average. So we touched that back in February, and we touched it almost right here in early April as well. So we haven't necessarily been a stranger to touching that slower, less sensitive moving average, but the point is the moving average from a 10-period perspective has not crossed over it. So only prices have touched it. The moving averages themselves, which have a lagging effect, have not crossed in any 4 of these yet. So we remain bullish from a longer-term perspective on all 4 of these indices. All right, moving right along, let's take a look at some other charts here. Let's do some 12-grid analysis. So remember, for this, I do have to kill that camera feed, so that way you guys can kind of see all 12 of these charts in detail if you so desire. And as we're looking at this first one, this is an Intermarket Analysis 12-grid. And basically when I'm looking at this, I'm trying to get a sense of trends that may or may not be developing. And so one of the areas that I actually taught a class on here a couple of weeks ago in my strategy lab class was on master limited partnerships. So notice in the upper right-hand corner here, ticker symbol AMLP, which is a way to track an MLP kind of exchange-traded product to get a sense of what they're doing from a broad perspective. Of course, you can go out and pick individual MLPs if you want, but this will give you a sense of how that asset class itself is doing. You know, we had a really nice day out of AMLP here today. It was up 2.4%. Of course, this area continues to struggle over the last couple of years because of the falling oil prices. But as you've learned by watching these videos in the last couple of months, oil prices have really stabilized and have actually become a leading component of the market. And so you're actually seeing that the oil prices themselves are trying to turn the ship around on all those master limited partnerships, which probably about 80% of them are involved in the midstream energy space, pipelines and storage, etc. So nice little bounce there out of AMLP. Keep your eyes on the MLPs. Now, also, keep in mind that those have separate tax consequences. David and I never give you any sort of tax advice or investment advice, generally speaking, so make sure MLPs are right for your tax situation. But we can say that from a chart perspective, it is stabilizing and potentially even rounding a corner here. We had this red moving average line signifying price below a falling moving average for most of that chart. Recently, we've really started stabilizing, heading higher. We even have a green moving average at this point. Now, speaking of crude oil is down below here in the lower right-hand corner. Notice how consistent that trend has been. Crude oil was up another 0.62% today, so really strong chart, especially in consideration that the dollar has been strong. Notice that in the lower left-hand corner, we have the dollar. UUP is a ticker symbol to track that from an exchange-traded product. And the dollar's actually been breaking out to the upside. Now, the traditional reaction of commodities is to fall to the downside, and that's exactly what we've seen out of gold, which is the chart right here, and also out of agriculture commodities, which is DBA, which is right here. But crude oil is kind of dancing to its own tune at this point. And despite the fact that the dollar's been rising, that commodity product right there continues to go higher and higher. Of course, oil market is sometimes affected by geopolitical news. Of course, a lot of news coming out of Iran and North Korea and all kinds of things going on that's kind of elevating oil prices themselves. Let's go ahead and take a look at our next chart here. Let's do another 12 grid. Let's do foreign stock markets in this case. And you can kind of see here, it's a bit of a mixed bag. We've got a couple of pink charts left on the board. That's just a reminder that those have a bearish posture according to the market forecast indicator itself using the intermediate term line. The rest of the charts do have green backgrounds, so that's a positive sign. However, it doesn't seem like many of the charts have great looking trends. You know, I've kind of pointed out the United Kingdom a number of times in the past as being kind of an exception of that, because you can see that the United Kingdom is actually up 4.3% over the last 3 months, and it touched a new 3-month high just today. So it's actually acting quite well. Canada, just above it right here, is up 3.4% over the last 3 months, so it's not quite up as much as England, but you can see that it too hit a new 3-month high here today. As far as other charts, I don't see any others that are hitting new 3-month highs. In fact, something kind of peculiar is happening there with Mexico. Mexico was down 1.4% today and is at risk of touching a 3-month low here, which is quite rare considering the reasonably bullish equity markets that we've seen here in the United States and elsewhere across the globe. So just be a little bit more cautious on Mexico at this time. Let's take a look at another 12 grid. Let's do a U.S. sectors 12 grid at this point. And, you know, it's kind of a mixed bag here as well. We've got a couple of holdouts. We've got the staples down in the lower left and the utilities second from the right there on the bottom row as well that remain bearish from an intermediate term perspective using that market forecast indicator. The rest of the sectors do have bullish postures, including, of course, the S&P 500 itself. As we're looking at some of the leading sectors out there, energy has been the story. So not only is it the MLPs that I talked about a moment ago, the midstream energy players that are doing reasonably well, but the exploration and production guys, the refineries companies, you know, basically anything in the energy space right now is doing pretty hot. In fact, for those of you that attended my sector-based trend trading class today, you know, our focus in that particular class is top-down analysis, where we're looking at what sectors are doing the best out there and then selecting individual stocks that are hot within those sectors to trend trade. And we did select an energy stock as the class vote here today when we did our collective intelligence gathering. So for those of you that are premium members of Market Scholars, you're welcome to go back and check the recording on that to see what stock we ended up selecting. But that's been a really hot area of the market, and it has continued to show promise as the days have gone on. So energy is very interesting. Keep your eye on it. We're actually going to talk about that here in a little bit with our trade application example. But before we do, let's now come on over here to do one last 12 grid. Let's do ratio charts on this one. And as you can see, from a ratio chart perspective, the main takeaway is it's a risk-on environment. And so as we look at these various charts, you know, some of the better looking trends out there, first of all, oil versus gold. This is what I was referring to before. Yeah, you can look at them individually, but if you combine them into one ratio, it's an interesting way to look at the chart because it basically shows you that money is flowing into oil and out of gold on a relative basis. And that has been a consistent theme for 3 straight months at this point. So that one has certainly been the best looking trend on the board. Here's what I was referring to before with the small caps versus the mega caps. Notice that for the most part, over the last 3 months, the small caps, and let me go ahead and right click on that and go to, actually, hang on a second. I'm just going to double click up here and that'll kind of expand it for us. But when this chart is going up, it means that the first ticker symbol, in this case IWM, is outperforming the second ticker symbol, in this case DIA, on a relative basis. And so in other words, what this is saying is that small caps are outperforming mega caps. And that has been the case for most of the last 3 months, but we have had a little bit of a spillover here in just the last 4 days or so. And of course, that makes sense. What I mentioned to you before with the Russell 2000 actually being down in price today, whereas the Dow completed its 8th straight up day, according to CNBC. From a news perspective today, we did hear some interesting news regarding legalization of sports gambling on a state-by-state basis. So that was kind of an interesting news story. Keep your eye on that and how it's going to affect different casino companies. If we wanted to take a look at what stocks did the best and the worst within the entire market today, one thing we could do is come on over here to the Market Watch tab, and let's just come down to... let me do the all stocks in this particular case. Now this 1,000 all stocks is the 1,000 stocks that we look at here consistently at Market Scholars. So it goes beyond the S&P 500, but it gives us a sense of a wide swath of stocks and how they're doing out there. Agilent in the healthcare space was the worst performer today. Viacom and Mattel second and third worst performers today. On the upside here today, let's try that again. For some reason getting a bunch of NAs in there. But anyway, Scientific Games was up 11%. And I don't know for certain, but I believe that's a company that is involved in gambling. And so that company may be benefited by what I just mentioned a moment ago, that sports gambling deal. Symantec was up 10% today. Chesapeake was up 7%. Prestige Brands 6%. And then there's an energy company that's Ecopetrol that was up 5%. I do see a couple other consumer discretionary and healthcare names there as well. So kind of a mixed bag there from that perspective. If we take a look at a sector basis on just a one-day basis, we do see that it was the energy sector that led the way higher. It was up 0.69% today. The downside mover was real estate, down 0.7%. So now let's talk about our trade application example for the day. And for this, I actually want to go and revisit an old trade. And so I'm going to pull up ticker symbol Halliburton. Now, some of you that watched the Market Outlook video when I originally traded this will recall that I referred to this particular trade as covered call on steroids. And so down below, you can kind of see what our position looks like. We have a long call. This is the $42 strike in January of 2019. So we have 249 days left until that one expires. So we wanted to buy that because we were bullish on Halliburton and energy companies back then. So as a reminder, when did we do that trade? We did it on April 11th. So that was more than a month ago. And so as a reminder, all these positive things we're saying about energy in the broadcast here today, we've been seeing it for a long time. This is not new news. We've been tapping into the strength in energy for a while here in these videos. But as you can see, we also sold a contract against it. In this case, it was the May 52.50. I said our best case scenario is that if Halliburton continues to go up, we would love to see it stabilize right at 52.50 because really it's like selling a covered call. But rather than having 100 shares of stock, we own one contract of a longer dated call, which controls 100 shares of stock. So it's a way to kind of leverage your buying power a bit more. But I said, you know, since our sold strike is at 52.50, our best case scenario is that we can have that stock trading at 52.50 on expiration day. And just so happens that this stock closed at 52.50 today. Now, today is not expiration day, but it is 4 days from right now. So this trade has worked out really well for us. what it's done is it's allowed us to maximize our potential on our long call here. You can see that we just bought one contract and we're up about $249 on that one call. And we're making money on the sold call aspect of it. Now, we're not making a lot of money, but that's okay because we know we're making up for that with the long call. But, you know, on the sold call, we're up about $9.50 right now. But because this thing is going to expire this Friday, we need to get out of this trade. Otherwise, we'd be at risk of watching the market makers or the brokers do an assignment on us there. And so we don't want to do that. So what we're going to do today is, first of all, let me show you what the chart looks like. So let's come back over here, take a peek at just a regular, I don't know, let's do chart 2A. This is our options chart that we use quite often. And let me go ahead and pull up Halliburton here. HAL is a ticker symbol. And so you will notice that this thing, after going up quite a bit, so we got into it right here. This would have been April 11th on this candle right here that I'm showing you. And then it did go up immediately after that. It's exactly what we wanted. And then it kind of stabilized. So fortunately for us, it didn't keep going up at that same rate. Because remember, we really sold away our upside potential above 52.50. It has really just gone sideways since then and just hung out right around 52.50. Now, you will notice that the price, or I should say the moving average itself, is going up at a nice trajectory. It's green as well, which tells us its price is above that rising moving average. So this is a trade that I want to continue to be in from the bullish side of the equation. In fact, I think one of the things I stated on the original trade back when I did it back in April was this would be a way for us to sell premium against our long call position and try to recoup all of our expense of that position by the time it expires next January. And then, of course, any gains that we make on the call itself would just be gravy on top. Now, that's ideal situation. You know, if Halliburton starts falling apart here in coming months, that's not going to work out for us. But that's the idea, at least, that you can kind of set your mind to. So what we're going to do for the trade application idea here today is we're going to roll our contract. So we have that 52.50 in May that's going to expire in 4 days. And we're going to lock in our $9.50 gain, and then we're going to extend that trade out further. So where I'm going to go with this trade is out to the June weekly contracts. These are the ones that have 25 days until expiration. And I'm going to try to roll this to a strike where we can roll up and out with a credit. And so you'll notice that we will probably be able to buy back our sold call somewhere between 55 and 58 cents when the market opens tomorrow morning. So then we can use, or we can kind of roll that to another strike to then kind of make up for that money we're spending on buying back that first strike. So down below here, you'll notice we have a June contract. Now this is again the June weekly contracts that are the 54 strike, as you can see down below here. I'm kind of pointing at it. And right now, if the market were open at this moment in time, which it's not, it's after hours, but if it were, we'd likely be able to sell that for 65 cents. So we're buying something up here for, let's call it 57 cents, and we're selling something down below for 65 cents. So we're actually going to improve our position by allowing our trade to go out to 54 now, the 54 strike, as opposed to the 52.50 as being kind of our top side selling away our upside potential. In the meantime, not only do we gain $1.50 of upside wiggle room that can be directly seen in the profiting of our long call, but we're also going to take in a credit for doing so. Not only are we going to get that credit to lock in on the gain that we had on this trade right now, but we're going to more than make up for any money we're spending to buy it back by taking in another premium out here in June. So let's go ahead and do that. I'm going to right click. Actually, I don't know if I'll be able to do it the way that I want. So hang on just a second. What I'll do is I'm going to buy this one back. Now, I know this is the one I have. For those of you that aren't familiar with the platform, this says position right over here, this red flag. That's the position I currently have. So I'm going to click on the ask price right there to say that I want to buy that back because that's currently where I'm short. So that's loading up my trade down below. And then on my June contract, I'm going to come down, scroll down to those June contracts. I'm going to look for that 54 call. And in this case, I'm going to hold down the control key on my keyboard, and I'm going to click the bid price. Now notice what happened. That loaded up our trade down below where it combined two different trade ideas. So again, just to verify I'm doing it the right way, I'm buying back the May 5250 that I'm currently short, and at the exact same time in this rolling trade, I'm selling a June weekly contract at 54 strike, and we're going to get a credit for enacting this transaction of 8 cents. So I'm actually going to change this to good till cancel just in case it doesn't get filled immediately tomorrow. I'd be happy to get that filled Wednesday or Thursday or what have you as well. But we will want to make sure we button this up by this weekend since it is options expiration week. So I'm going to go ahead and click confirm and send, and off we go. So we'll see if we get filled on that tomorrow. Well, I want to thank you for tuning in today. It's been a pleasure to go to work for you again. I will plan on doing the video again tomorrow as long as I get 100 likes on Twitter. So do your part. Go over there right now. Click the heart button. I showed you 4 different ways you could get that accomplished earlier in this particular video today. So with that, I want to wish you all the best with your trades and your investments. Have a great night. Take care. Bye-bye.